Berkshire Hathaway just reported earnings. It was an amazing report, in my opinion. I'm going to talk about it in today's video. The stock has been finally starting to recover. I did two videos on Berkshire calling it too cheap to ignore and highlighting all the hate that you see on X of people putting up Berkshire versus the S&P and saying Buffett lost it and making fun of Berkshire. Well, no one's making fun of Berkshire anymore. Since then, the stock is up about 10%, 11%. That may not sound like a lot, but it's pretty good for a big company like Berkshire. And the new CEO, Greg Abel, is doing a lot of interesting things within the company. Now, I always laugh whenever I go on Berkshire's investment relations page. This is how the page looks like. If you didn't know, they don't have any fancy presentations, no fancy web design. It's like been the same since the 70s or the 80s, or even the 60s for that matter. I mean, it's been crazy how much those people really care about what matters, which is a number, and not much about the aesthetics and all these things to try to sell investors on the company. Now, if you look at the company's financials, they posted a pretty amazing quarter from $12 billion in net earnings to $25.5 billion. This is a massive increase for the company. But what was really surprising to me is the increase in operating earnings, because a lot of the increase was investment gains. It went from $5 billion in gains to about $12.6 billion on some stocks they realized profits on or whatever. But the operating businesses grew really well, from about $11.1 billion to about $12.9 billion. That's pretty amazing for a company like Berkshire. Now, if we look a little bit deeper at the operating earnings, the insurance underwriting has declined from $1.9 billion to $1.7 billion, and the insurance investment income has also declined by about $300 million. Now, the reason why the investment income has declined is due to a lower interest rate basis year over year. Last year we had higher rates. This year we have lower rates. Berkshire invests them in T-bills, so those T-bills are yielding a lower rate versus the prior year, which causes a decrease in insurance investment income. In terms of underwriting, it's not really a good sign, but it happens sometimes with Berkshire. There's some cyclicality to it. If you look at it on a 6-month basis, it's still increased, which is not bad for a mature business like Geico. Now, BNSF, which is a railroad, has done really well, from $1.4 billion to $1.5 billion, and they're still lagging on margins behind a lot of their competitors like Union Pacific and other companies. BNSF has an amazing network in the United States, railroad network, that's pretty much impossible to rebuild or impossible to replicate. And this is an amazing asset for Berkshire that Charlie Munger said he believed that it will pretty much last forever and it will be the hardest to disrupt. And I believe this is true. No other method is more efficient than rail. Even if you have those trucks that drive themselves, you can't haul like 100 or 150 trailers. You could only haul one, maybe two trailers maximum. You can't haul 150 trailers like you could on a lot of those railroads. So this is an amazing asset. Now, Berkshire Hathaway Energy was also an interesting one. It went from $700 million to $891 million. This is the utility business for Berkshire. We have a lot of the build out in data centers. Greg Abel mentioned that this is an amazing opportunity that Berkshire is going to capitalize on, and it could be an amazingly growing free cash flow business for Berkshire. Now, something that he said during the annual meeting that a lot of people didn't know is that 15% of the natural gas consumed in the United States, it's touched by our pipeline network or one of our core assets. So the Berkshire pipelines that they own a lot of those natural gas pipelines, and 15% of the whole supply of the United States of natural gas pretty much flows in some way throughout those Berkshire pipelines. So this is an amazing national security asset, and it's a hard asset as well that brings in a toll bridge like cash flows, and it's not going anywhere anytime soon, especially with the build out of data centers. Now, manufacturing was also very strong, from $3.6 billion to about $4.4 billion. This is another business that I mentioned that could benefit from a lot of the data centers, because this business, which one of them is Precision Castpart, they own a lot of those equipments that go into the engines and into a lot of those gas turbines, like the Bloom gas turbines and other gas turbines that they've been putting up on those data centers. Well, a lot of those parts are manufactured by Precision Castpart, and this is really a great business that the Berkshire owns. They own others as well, but I believe this is one of the best of them in their manufacturing segment. Now, I have to mention that a decent portion of the gain in the operating earnings of those businesses was due to others. Others went from like 32 million to 1.2 billion dollars. Now, what others is, it's mainly foreign currency, I believe. The foreign currency gain was like I believe like 326 million in the second quarter. So that was a pretty big one, and it really helped boost the growth. If it wasn't for the currency gain, the company would have grown in operating earnings, but not as much as it did because of the 326 million, or about 575 billion in total. Now, in terms of Berkshire's balance sheet, the company is finally starting to buy stock. It has reversed the pattern of selling, and it became a net buyer of equities in the second quarter with nearly $20 billion in net purchases. The cash position has declined from $47 billion to $35 billion year over year. And this is an amazing sign to see. They even invested in Google recently and a lot of different companies. And I really like what the CEO is doing in general. Now, they also started buying back stock more aggressively. Over the last quarter, they bought like 200 or 300 million. And people said they're not buying back enough. And I tried to tell you guys, there was like a lockout period into the annual meeting. So they only had like a week and a half for them to be buying back the stock. Well, now they had a full quarter, and Greg Abel deployed $4.5 billion in terms of buying back Berkshire's own shares. And I believe that's much better for shareholders than for Berkshire to just be sitting in cash and collecting 3.5% or 4.5% on those treasuries. So I like what the CEO is doing, and especially at the valuations we've seen, about 470, 475. I mean, Berkshire was really too cheap to ignore. And even over here, Berkshire is still undervalued. Now, if you look at the traditional metrics that most people use to value Berkshire, it's mainly the price to book ratio. So average price to book ratio for Berkshire was about 1.4 times. Now it's trading at about 1.5 times price to book. So it's not really crazy above its historical average. It's still within a reasonable range. It traded as high as 1.8 times, now trading at 1.5. So it's not really above its historical range. But there's something that's also very important that the CEO Greg Abel highlighted during the annual meeting is the fact that the book value doesn't really include the current replacement cost of their assets. It mainly includes the initial cost basis of their assets. This is what he said. He said, you can take book value because we have everything at a historical cost basis and try to adjust our various companies. That a BNSF is recorded on the books at the original price we bought it at versus what it's valued at today. So those companies like BNSF, the pipelines, Geico, all those companies are much more valuable than they were 10 or 15 years ago. But Berkshire still has a valuation of 10 or 15 years ago. So Berkshire here is not really trading at 1.5 book value. Maybe it's trading at 1.1 or 1.2 times book value if we really adjust for the fair value of those assets. But I'm not going to do that in today's video. Now, the way I like to value Berkshire is I like to look at how much I'm paying for the operating businesses and how much I'm getting on the side in terms of a cash position and in terms of the portfolio in general. Now, if you're buying Berkshire today at about $520 per share, you're getting about $170 in just cash and cash equivalent. You're getting $151 in stocks. In terms of the operating businesses like the pipelines and Geico and Berkshire Hathaway Energy and the manufacturing business and all the operating businesses, you're paying for them about $216 for the operating businesses per share. Now, in terms of the valuation that you're paying for the operating businesses, you're paying right now about 11.7 times earnings, and you're getting $170 per share in cash, and you're getting $151 of the portfolio. So I believe Berkshire here is still undervalued in my opinion, but I would not expect a life-changing return. Like if you're in the market to make 20, 25, 30% a year, Berkshire is not going to do that. If you're looking for 8, 10, 12% a year and some stock that's a little bit more defensive versus tech and AI and quantum and going to the moon or whatever, then Berkshire is a pretty amazing bet on this part. But I don't believe it's going to make anybody rich, and I don't believe it's going to return more than a 12 to maybe maximum, I would say 13% annual return from today's prices. So that was my update on Berkshire Hathaway. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.